The live price of Nuburu stock is currently trading at 0.1566 per share during this ongoing intraday trading session on Friday, June 5, 2026, marking a significant downward push of roughly 7.99%. While high-volume penny stocks frequently see these types of daily swings, what most retail market participants are completely overlooking right now is a major shift behind the scenes in their institutional defense billing pipeline and their recent Italian structural transaction. Everyone is watching the tape drop closer to the 52-week low of 0.1528, fearing immediate delisting pressures from the NYSE American Exchange, but the actual balance sheet dynamics have quietly undergone a complete reversal that hasn't registered in general market sentiment yet. The standard expectation surrounding Nuburu stock is that it is a highly speculative, cash-burning microcap that cannot keep up with its structural listing obligations. Retail traders looking for the next short squeeze look at the massive trading volumes, which exceeded 22 million shares today alone, and treat it as a pure gamble. They assume the company is stuck in a terminal spiral, especially given the historical context where the equity value crashed down from its 52-week high of $4.24. This common narrative causes short-sighted panic whenever a single-day sell-off hits the tape, driving people to jump ship and look for massive tech heavyweights like Nvidia stock, Apple stock, or Tesla stock to park their capital safely. But the underlying reality is far more complex and suggests a classic expectation versus reality disconnect. Just days ago, on June 1, 2026, Nuburu announced a massive expansion of its defense and security framework, pulling in roughly $1.1 million in commercial orders through its subsidiary Orbit SRL for Tier 1 critical infrastructure protection. More importantly, their mid-May financial updates showed that they successfully fought their way back to positive stockholders' equity, reporting roughly $3.2 million against a previous deficit. For a microcap fighting a compliance clock, shifting into positive equity territory changes the entire calculation for institutional survival, yet the stock is still trading as if it faces immediate bankruptcy. This massive divergence between a beaten-down share price and an accelerating defense order pipeline is exactly what creates opportunity for retail traders utilizing self-investing strategies on popular trading apps. Whether you are managing long-term assets through Schwab Intelligent Portfolios or conducting high-frequency execution on the Interactive Brokers platform, microcap equities experiencing heavy daily volume require a deep understanding of structural corporate mechanics. Experienced retail investors using automated online investing platforms or standard online investment configurations often miss the microcap space entirely because big institutional players do not cover these firms. When you evaluate daily swings in market momentum, trading volumes tell a fascinating story about who is currently holding the line. Over 39 million shares move through this ticker on an average day, highlighting an incredibly active speculative community. Today's drop down towards 0.1544 at the daily low shows that short sellers and panicked retail accounts are dumping shares rapidly, completely ignoring the definitive share purchase and investment agreement the firm signed on May 27 with Tecne SPA. This transaction initiates a critical golden power filing process for a majority acquisition, a geopolitical compliance hurdle in Italy that could fundamentally rescale the entire operational profile of the business if approved. Macroeconomic pressures continue to weigh heavily on small-scale technology developers, especially as rising capital costs make traditional borrowing lines virtually impossible to maintain. This environment forces retail market participants on various investing sites to seek clear investment help regarding small-cap risk management. When macro pressures squeeze microcaps, liquidity is the only metric that truly dictates near-term survival. Traders navigating individual brokerage setups at institutions like Fidelity Investments look closely at how these firms handle toxic debt or dilutive equity lines to keep the lights on, and Nuburu has historically relied heavily on complex financing structures that dilute existing equity holders. Understanding how a business scales from a developmental lab into a commercial manufacturing requires analyzing what the company actually builds. Nuburu designs and manufacturing high-power, high-brightness industrial blue laser systems, a technology that differs significantly from traditional infrared industrial lasers. Blue light is absorbed much more efficiently by highly reflective metals like copper, gold, and aluminum, making it far superior for applications in electric vehicle battery manufacturing, consumer electronics assembly, and aerospace engineering. Because blue wavelengths can weld copper up to 8 times faster than standard infrared systems with fewer physical defects, the industrial value proposition has always been strong, but translating that technical edge into a stable corporate business model has proven to be an uphill battle. The company's older financial reports paint a vivid picture of the severe cash burn that led to the current equity valuation collapse. Looking back at past performance, their first quarter revenue for 2026 came in at just over $407,000, which represents a starting point for commercial traction, but remains incredibly small compared to their multi-million-dollar quarterly operating expenses. For a long time, selling, general, and administrative costs hovered at unsustainable levels, tracking above $7 million in recent quarters due to intense compliance costs and structural reorganizations. This historic performance is why the broader
broader market continues to punish the stock, treating the underlying business as a permanent cash incinerator regardless of recent contract wins. Now, as the market processes the latest sell-off, a major point of contention among market participants centers on how the firm will maintain its listing status on the NYSE American Exchange. Speculators utilizing popular retail applications like the Robinhood app or mobile portals connected to Fidelity Brokerage are watching the tape closely to see if management can push the stock back above the $1 mark, or if they will be forced to execute a massive reverse stock split to satisfy exchange requirements. Comment below how many shares of Nuburu you currently hold, or if you are avoiding microcap penny stocks entirely in this current high interest rate environment. Looking ahead, the future outlook for the company relies entirely on 3 specific near-term catalysts that will determine whether reality can ultimately triumph over depressed market expectations. The first major scenario involves the execution of the Maddox Defense joint venture, which is currently advancing through a funded prototype build phase aimed at a formal government demonstration. If this prototype satisfies military requirements, Nuburu will gain direct access to a counter-drone market estimated to be well over $20 billion globally. For a company with a total market capitalization currently hovering right around $31 million, even a minor slice of a government defense contract completely alters the fundamental valuation metrics. The second critical milestone is the successful regulatory clearance of the Italian Golden Power filing for the Tecne acquisition. If European regulators approve the structural majority stake, it creates a direct commercial pathway into continental defense and critical infrastructure frameworks, providing a steady stream of contract visibility that could stabilize their volatile revenue stream. The primary risk associated with this scenario is regulatory gridlock or protectionist policies that block the technology transfer, which would leave their foreign subsidiaries stranded without a clear path forward. The final scenario to monitor is the stabilization of internal cash flow and the elimination of further dilutive financing lines. If the company can leverage its current positive stockholders' equity to secure traditional non-dilutive credit lines, it will alleviate the constant downward pressure on the share price caused by institutional short selling. However, if revenues fail to scale past the $500,000 mark over the next 2 quarters, management will likely have to tap into highly dilutive equity lines again, erasing the progress made on the balance sheet and punishing long-term retail holders. When you look across the broader ecosystem of modern digital wealth management, individual brokerage platforms have made it easier than ever for regular individuals to access volatile microcaps. Investors utilizing Fidelity mutual funds or building portfolios via sophisticated SoFi robo-advisor structures usually stay far away from these single-digit cent equities due to extreme volatility metrics. Yet for self-investing participants who leverage the robust analytical tools on the Interactive Brokers platform or track institutional flow through advanced features on the Robinhood trading platform, these deep value anomalies present a highly calculated expectation versus reality equation. The core struggle for the business remains a classic race against time and liquidity constraints. While larger industrial tech firms can easily absorb millions in research and development expenses, a microcap must find immediate commercial viability or face relentless equity dilution. The massive gap between what the market expects from this penny stock, which is a quiet delisting and eventual bankruptcy, and the emerging reality of multi-million-dollar defense pipelines and positive equity restoration creates a highly unstable trading range. Daily swings like the 8% dock seen today will continue to happen as short-term traders cycle in and out of the asset. To bring this analysis to a clear focal point, the central insight guiding this company's trajectory is that its survival is no longer purely a question of technical performance, but rather a game of structural execution. The market's expectation remains anchored to a history of severe cash burn and significant wealth destruction for early shareholders. The emerging reality, however, shows a restructured balance sheet with positive equity and a rapidly materializing defense order book. If management can successfully execute the counter-drone demonstrations and clear the European regulatory hurdles, the current valuation will look like an extreme historical anomaly. If they stall, the risk of terminal dilution remains highly real. For an objective look at this asset, keeping emotions completely out of the daily tape and focusing purely on the quarterly revenue restoration is the only way to navigate the extreme volatility.